Hello, business owners. Welcome to today's live. My name is Lunta Di La Paulo. I am the managing director of Yeto Accounting and Tax PLLC. I am excited to be here with you tonight because we have amazing information we want to share with you because we know and we believe that when business owners succeed, our nation, America, succeeds. So, again, welcome. And today I want to share with you some very important information, very valuable information, and we're going to be talking about how you can enhance your business value before you exit. And the premise for this conversation is really understanding what is happening in a potential buyer's mind, so that we can reverse engineer your business to deliver exactly what the potential buyer is looking to see in your business. So very often business owners are caught up in a situation where they have to rush to the finishing line, okay, and they will try to sell their company in a stage that is not favorable to them, that is not helpful or useful to them as business owners, leading to not actually having the expectation they had for an exit, right? So, as you know, there are several ways that you can exit. You can transfer your business to your heir, your family members. You can just close it, wind it down, and go with your life, or you can potentially sell your company to various potential buyers. Um, so what's really happening is the premise of this conversation is to look at what you need to do to increase your business value before you can sell the company, right? So very often what I saw happening in my professional career as an investment banker was that many business owners would come to us as advisors looking to sell, and I knew that their businesses wasn't ready for sale. Based on my experience with other business owners, based on my conversation with business buyers, especially private equity firms and family offices or independent buyers. So I knew what these people were looking for, what they were willing to pay premium on, but a lot of business owners did not really do a good job, not only preparing their company but also taking the right steps that are absolutely necessary to increase your business value before you can exit. So what I'm going to be doing in this live right now is to show you what exactly business buyers are looking for, so that you can start preparing your company exactly for that, and what you can start doing today to increase your business value. Okay, so that's what we're going to be doing today. Okay, let me share my screen with us here, and I just want to share one window, and I believe you can now see my slides here. Okay, so these slides should be showing you. Let me actually magnify this view because I want this to. Okay, I don't know what I'm doing. Probably I do know, but this is not what I wanted to show you. Okay, so I want to maximize my slides. That's great. Okay, this is the view that I wanted. Okay, perfect. So here what I want to show you now is what business buyers or potential buyers are looking for in a business, right? They are three things that absolutely business buyers want to see, right? Number one, they want to see a company that is profitable with positive cash flow. They are other business buyers out there that are looking for distressed companies, right? Businesses with a lot of problems, with liquidity issues, with cash flow negative, or net loss. But most business buyers are not going to be looking at those kind of business. Most business buyers are actually looking for businesses that are profitable and have cash flow positive. That's number one thing they're looking for. And ideally, they want to find a business that is generating a profit of at least $500,000 per year. Okay. If you have a business that crosses that threshold, you're setting yourself up for, you know, very good buyers potentially, and you want to have your business at least $1 million in revenue. Business buyers are also looking for businesses that has not necessarily the best or the most perfect business systems and processes, but a company that has very clear business systems and processes in place. They have a process for hiring, recruiting, hiring, onboarding, and training employees, and the same thing for client, creating value for clients, offboarding employees or clients, right? Managing payroll, managing their accounting and finance, and so forth, right? There are different systems for that. Potential business buyers also want to see a company with a strong a line of succession in place. That means essentially a company that has a strong management team that doesn't necessarily rely exclusively on the current owner to operate the business, right? What we often see is a business owner who essentially is the absolute life of their company. That's a very bad position to be at, because when you're the only person who knows how the job is done, who does what, where to get what, all the intellectual capital of the firm is within you as the business owner. That's a really bad problem to have, and we often see these with service driven businesses, right, where the owner is the only person who knows how to bring clients to the firm, is the only person who knows the different relationships that exist in the company with bankers, with clients, with vendors, and so forth, right? That's not an ideal position to be. As a business owner, you really need to make sure that you are pushing to other members of your team as much responsibility as possible, delegating to them the functioning of the company and not the entire and absolute reliance on you as a person. Because the moment you become sick, heal, and unable to serve your client, your business can drastically lose significant amount of value. The moment you die before selling the company, you die with the business, right? That's what we often actually see, right? So to minimize this kind of risk, to reduce this level of risk that is absolutely high, we need to make sure that business owners are preparing their companies for their eventual exit, right? So if you can address the profit side, the cash flow side, right, your working capital side, your business processes and systems, you are building a strong management team around you, then you are starting to set up your company for success. So before you ask me the next question that is obvious, right? Let me go ahead and share with you what you actually need to work on to address these issues. So let's look at for the first angle, okay? From your financial side, okay, your financial perspective. What we try to begin with is to do a gap analysis to understand not only your financials but also connect it with your operations, right? So what we have learned in the past several years working with business owners and potential business buyer is really some of the key indicators or financial metrics that we are seeing can be a deal breaker in many transactions. Number one, potential buyers are looking for a company with a revenue growing at double digit, right? That's typically what they're looking for. And a reasonable CAGR for the last 4 to 5 years is usually 15%. Okay, CAGR stands for um, accumulated. Okay, I'm missing this. Okay, let me actually Google it. I literally forgot what CAGR stands for. Okay, uh, that's interesting. I should have known this. Compound annual growth rate. That's it. Compound annual growth rate. Yep. Business buyers are looking for a compound annual growth rate of at least 15%, right? So I put here over 15%. And they want to see a revenue size of at least $1 million, right? That's kind of the place where they find a lot of excitement, okay? The minimum revenue of $1 million annually. The other indicator they want to see in revenue is predictability. And the way they measure predictability is to see your history of forecasting sales projections, right? So a lot of business owners actually don't have this documented. They don't have, for instance, their projections and their variance analysis between what they projected and the actual sales in for a given month, quarter, or year, right? So the higher the closer your revenue projections are to your actual sales, the better that confidence is at predicting revenue in the future more accurately. The other item that potential business buyers are looking to see is long-term tenured clients, right? I understand there are a number of industries where you have a lot of one-off type of clients, but business owners or business buyers, excuse me, really want to see that you have a company with a significant portion of long tenured clients, right? Clients who have been with you 2, 3, 5 years or more, right? They are repeat buyers. They are constantly, they come to you, and there is a relationship there, right? Not a lot of churn, clients leaving your firm because that raises a lot of red flags. The other item that business buyers want to see is the level of recurring revenue, right? If you can set up, excuse me, your business in a way that there is a high probability of recurring revenue, the better your business is gonna be. Okay. And the last item here, right, that I want to explain around revenue is that the main portion of your revenue needs to be from the clients that you get directly and not as an independent contractor. We often see this in the contracting space, right? There is a company that wins a big job and then they bring subcontractor to do part of the job. If you are that second or third or third level subcontractor, your revenue is not necessarily uh, seen in a good light from potential buyers' perspective. So those are some of the items that we really pay attention at when we are reviewing the revenue side of the profit and loss statement. And the next item are the operating expenses, right? We want to make sure that your operating expenses are predictable and are stable. Business buyers don't want to see significant jump or volatility in different line items, especially right around your payroll, okay, or around COGS. If you have cost of goods sold that is volatile or that is fluctuating quarter after quarter, right, you gotta have a good explanation for why that's the case. What I have seen often happening is some business owners in one year they put certain expense in the cost of goods sold, and the next year they're gonna put it in operating expenses, and then the following year they're gonna move it elsewhere, right? And that creating significant volatility. That might not necessarily be volatility per se, but that inconsistency in your financial reporting raises a lot of suspicion to a potential buyer. So you want to make sure that your financial reporting is spotless, is accurate, is as accurate as it can be. Okay, so we want to make sure that there is stability, there is predictability in your expenses. And one good way for us to know that is if you have a budget. A lot of small businesses, unfortunately, do a poor job with their operating budget. They don't have an operating budget, and those who do, they're not monitoring it. They're not running variance analysis. They're not comparing their budget to the actual expenses and trying to understand where the gaps are, why the gaps took place, and so forth. That's very important. And the last item that I want to make sure that I include in this conversation is owner related expenses. Almost 100% of us small business owners are running a certain degree of expenses that are specifically for ourselves into our companies, right? Things like the cell phone, the internet, certain business meals, certain membership, subscription, or certain dues or professional fees, right? That are owner specifically related. What we really want to make sure, especially for those of you starting to prepare for their exit in the next 2, 3, 5 years or 10 years, you really want to make sure that you're starting to minimize these kind of expenses, because the more personal expenses you run through the business, the more distorted your financials are gonna look like. Okay, because the size of personal expenses you run to the business can actually distort the true profitability, right? And by the way, very good professionals, they will create a normalized financial statement that they will use to run their valuation on. Okay, so when you actually see a valuation report, your P&L looking different to what you run on a monthly basis or quarterly basis, you'll see significant difference there, right? Why? Because they have to remove owner specifically owner related expenses to make sure that the financials actually reflect the true profitability of the company if it wasn't being run by a related party. Okay, and the last point that I want to add here on the OPEX, right? Your operating expenses need to be reasonable and close to the fair market rate. Okay, your expenses. So let me give you an example. If your vehicle expenses, if you are, let's say, a daycare, and you're spending, let's say, $100,000 in vehicle expenses, that may not be reasonable for you if the average daycare expenses in the area could be around $20,000 per year. Okay, so your operating expense need to be in line with what the average company or a similar company to yours could look like. So that's our profit and loss statement. The next item we're looking at the balance sheet. On the balance sheet side, we want to see that you're building a company that shows a growing and strong financial position. A company with a sufficient or a history of sufficient working capital, right? A company with a short cash cycle, a company with an above market rate, above market current and asset ratio, right? Those are very much liquidity ratio. If you're in an industry with a that requires significant investment in capital expenditure, then we want to make sure that we're seeing a growing, capex in your company, right? Because if we're not seeing reinvestment in the company, that can tell us that you're not reinvesting in the company, and therefore the fixed assets you have today may be coming to an end of their life, and therefore whoever is going to buy the company needs to account for a major capex replacement in the future. If you are a tech company, we want to make sure that we're seeing some form of growing portfolio of intellectual property in on your books. Okay, so and these are some of the items that we want to see on your balance sheet. Okay, unfortunately, we also see this as a problem for many small business owners. They do not have a balance sheet in their of their company, which is a big problem. Outside of the assets, we also want to make sure the liabilities are accurate. A lot of business owners have a lot of off-balance sheet items, right? So you wanna report as close as possible your liabilities to in your balance sheet. And the last item, you really want to make sure that your equity structure is simple, nothing complicated, nothing crazy, something streamlined, something simple, something to the point. Okay, so that's really what we want to make sure that we're seeing. Strategy wise, right, we want to see a business that has a clear value proposition. Who are you serving? What problem are you solving, and how you're solving those problems, right? You have a viable competing strategy. Like, this is what differentiates you, and your team understands how to create, deliver, and manage value for your customers. We want to see operations with offering that is not commoditized, right? Operations with product or services that will command a premium in the marketplace. We want to see operations that has a robust intellectual property. We also want to see a company with a strong management team capable of leading the company with or without the owner in place. Okay. And similarly, we want to see very well trained staff that is capable of fulfilling the client's needs, right? Because at the end of the day, the staff are the ones who are in the front line servicing the client, and that's really how it should be. They need to be very well trained, they know what they're doing, they know their responsibilities, and so forth, right? And the last point that I want to add here, you gotta have a team that knows how to win sales, how to close sales, how to onboard clients. If you're not doing that, if you're not training your team to exactly do that, right, you're not setting up your company to succeed. So business owner, if you've been following us, right, we always I encourage you to think about the fact that you gotta lead your company as if you were a publicly traded company, because the moment you start thinking of yourself as a publicly traded company, you absolutely need to improve your financial reporting, your internal controls, streamline your operations for efficiencies and effectiveness in order to create massive value for your shareholders. And guess who's the shareholder? It's you, right? So if you're not doing that for yourself, right, you may be setting up your firm, your company for inevitable, okay, value loss for yourself and your family. So we're gonna pause here in a little second, but I want to make sure that you understand that there are certain functions you need to have in your firm, okay, that you need to think about implementing, things like finance department, client acquisition, talent acquisition, value creation, and your strategy. Finance, we're talking about your accounting and financing responsibilities, right? Cash flow management, we're talking about your bookkeeping, record keeping, your taxes, and compliance. In the talent acquisition, you gotta make sure you have a marketing team, a sales team, or sales support, building your brand, bringing client, building a strong pipeline, and bringing new clients to the firm. Talent acquisition, right? Your human resources, your talent pool. You gotta have a system for bringing new client, new talent, new employees, training them, onboarding them, developing them into good leaders inside your company, right? And then under your value creation, you gotta have an operations management structure that allows you to actually create, manage, and deliver value to your clients, right, in a cost effective manner. Otherwise, you're going to be losing a lot of money. And then under your strategy, right, you have a management system that understand your vision, your strategy, you're set up to succeed as a business owner. So we have here a checklist that you can take, if you're watching these later. Just ask us your business health checklist and we'll send it to you so that you can take score of your own company. um, I think this is probably a good place for us to stop. I'm gonna come back here in full mode. Okay. So again, if you need help, if you have any question, please do not hesitate. Don't be a stranger. Reach out to us. Our email address is hello at 7exitmistakes.com. And again, hello at 7exitmistakes.com is, rolling under there for you. And we also have a free gift for you, right? We have written an ebook that covers 7 exit mistakes that business owners seeking to sell their company make that cost them a fortune. The link is also underneath there. You can download the ebook and, let us know if there is anything we can do to help you. Please follow us on social media to get notification for any new content, any live that we are creating or producing. Again, it's been great spending this time with you. I hope this was valuable to you, your company, and your family. And again, if we can be of help, we're here to help you. And excuse me, if we are not a good fit for you, we understand, but we would like to ask you, please seek help, find somebody who can actually help you. Okay. Have a great rest of your day, and